Good day, my good students of JPTS ISQ. My name is Dr. Clement Ogbani. I'm presenting a lecture on ACF 303 Management Accounting. So this is the first lecture of the series. So we are going to be looking at management accounting. So in management accounting, we need to first of all understand the meaning of management accounting. Management accounting is also known as managerial accounting, and it can be defined as the process of providing financial information and resources to managers in decision making. Management accounting is used by the internal management of an organization to run the organization. So it differs from financial accounting, which is useful both to the internal management of the company and also to outsiders. When we study financial accounting, we learned that financial accounting can be used both by the management, by the owners of the company, and also by outsiders like the suppliers, the investors, the customers, and also the tax agencies. But management accounting is purely used for the internal running of an organization. And so the objective of management accounting is to use statistical data and to take a better and accurate decision in controlling the enterprise, in controlling the enterprise business activities, and also it will enhance development of the organization. So management accounting is a little bit different from financial accounting, not just because of the usage, but also because of the focus. The focus of management accounting is providing information that will help managers to take a good decision. And it becomes very critical because it is the decision that an organization takes that makes the organization whether to perform well or not. So all lies in the decision taken by the organization. So we know that every aspect of accounting is about decision making, but management accounting is focused on making the managers to take good decisions. Areas where management accounting comes in are as follows. Number one, you have the product costing and valuation. Product costing and valuation. Here, management accounting tries to accumulate cost, to analyze cost, to accumulate cost, to analyze cost, so that they can be able to categorize this cost into variable cost and fixed cost, into direct cost and indirect cost. Because it is the fixed costs are those costs that they don't increase. The cost don't increase even when output increases or decreases. When output increases or decreases, the fixed cost remain the same. But variable cost, if output is increasing, variable cost will increase. If output is decreasing, variable cost will also decrease. Then we have the direct cost and the indirect cost. The cost that we can trace to unit produced, we refer to them as direct costs. While the cost we cannot trace to unit produced, we refer to them as indirect costs. Just like labor, if you know you need 5 people to do a job, you can easily trace the job done by the 5 men. It's a direct cost. But you cannot trace the job done by an administrative staff because an administrative staff covers even when the organization is not producing, administrative staff are still there. And even if production goes up, the administrative staff are still there. Just like security, the security expenditure, whether the organization is increasing production or decreasing production, the security expenditure remains the same, at least for a year. So the cost account, the management accountant isolate cost into direct cost and indirect cost, into fixed cost and variable cost, so that they can know the total of all these costs, so that they, at the end of the day, they use it to calculate the total cost, and also to analyze how these costs interact in order to determine the cost behavior of that organization. Now, we also cost management accountants are also concerned with cash flow analysis. Cash flow analysis is the real measure of the liquidity of that enterprise. Cash flow analysis is the actual measure of liquidity of that enterprise. Because even when we prepare in financial accounting, we prepare trading profit and loss account, we prepare our balance sheet, we prepare our statement of retained earnings. We all those one does not give us the true liquidity of that organization. It does not give us the true movement of cash. Example, the trading profit and loss account only tells us the expenditure made and the income generated. While the balance sheet will just tell us that at a particular day, this was the position of the asset and liability and capital of that organization. The retained earning statement is only telling us if there's improvement in the shareholders' fund, maybe due to profit made. But in the case of cash flow analysis tells us divide all the activities of the organization into three. One, we have the operating activities. Two, we have the financing activities. Then we have the investment activities. So the operating activities are the day-to-day activities that can be done in an organization in terms of like sales, purchases, repairs, and maintenance. These are operating activities. While the financing activities are how the company raise funds to meet up with their projects. Then the investing activities is how the company invests in capital expenditures, how they invest in capital projects, how they invest in capital projects these are the assets that we capitalize, and they appear on the right-hand side of the balance sheet as fixed assets. So now, in doing this, the management accounting we look at the cash inflow from operating activities and the cash outflow from operating activities. The cash inflow from financing activities and the cash outflow from financing activities. The cash inflow from investing activities and the cash outflow from investing activities. So at the end of the day, they're able to determine the net cash flow. So management accountants are also concerned with inventory management. That is how the inventory we're talking about raw material, we're talking about work in progress, and we're also talking about finished goods. So if the inventory analysis is is increasing and decreasing, is also part of management accounting. Then we have the constraint analysis. So anything we want to do, there are certain things that we must that constrain us to determine the extent that we can go. Like if a company said they want to produce 10,000 units of a particular product, let's say a company said we want to produce 10,000 units of let's say a flour mill. Say we want to produce about 100 trailers of flour. So if they want to do that, the cost rate analysis will let us know, one, is the money available? Do we have the labor that will do the job? Do we have our machine? Do they have the capacity? And also, what is the market absorbing rate? All these are cost rate analysis, which a management accountant is expected to do. Also, carry out financial leverage, and we also monitor our budget. These are things that are of challenge to an organization that regarding decision making. And financial management accountant try as much as possible to look at those to look at those issues and advise the organizations appropriately so that they can take a good decision. Then uh, another aspect of management accounting is the costing aspect of it. That is the costing aspect of it. In management accounting, we try to, like I said before, we divide the cost, the expenditures of an organization into four major areas. We have the fixed cost, which I said remain constant even when the production, the unit produced goes up or comes down. Example of fixed cost is depreciation, because you have already set aside how much you will use to depreciate an asset per year. So even when the asset is not used, you have already set aside how much you will use to depreciate an asset. So the level of usage does not affect the depreciation. Another fixed cost is the amount paid to administrative staff, the administrative expenses, interest on loan, all those ones, and also rent. These are fixed costs. Then we have variable costs that varies with unit produced. That as the unit produced is going up, they will go up. Example of that is things like purchases, carried inward or carried outward, repairs and maintenance. We talk of a discount allowed. We are talking of transport and traveling. All these ones are they continue to vary as the output varies. Then we have operating expenses. Operating expenses are those day-to-day expenses that are incurred by the organization. So these are the costs we are talking about: the operating expenses, the direct costs, the indirect costs. All these are a management accountant trying to categorize the costs incurred by the organization into these different cost criteria. And in doing this, it helps us to understand the cost behavior so that we can advise the organization effectively. It is this cost behavior that gives us an idea of break-even analysis so that we can use the break-even analysis to determine the quantity we produce at which we can make profit, and the quantity we produce at which we can just be in a level of equilibrium, and the quantity we produce at which we can make a profit. And this break-even analysis is based on idea of fixed cost, variable cost, and sales. So in break-even analysis, we say fixed cost all over selling price per unit minus variable cost per unit. So it gives us our break-even point, which is the point at which we are not making profit, we are not making loss. But if we increase production, henceforth, we are going to make a profit. So it helps the organization to determine the unit at which they will produce so that they can make profit. Then we also have in cost management, in cost accounting, we are not carrying out just recording of cost. We are also interested in managing the cost so that, because if your cost is high, you will not make a profit. If your cost is high, you will not make profit. So we manage costs to ensure that the costs are kept low so that they will not affect our profitability. So one of the ways to do this is to go through the steps of cost management. First of all, we set up, we have a setup phase where we determine how and map out the plan of how the costs are to be managed, how they are to be tracked, and how they are to be, you set standard for the different costs. And two, we engage in resources planning and also budgeting and cost estimation. Budgeting is you prepare ahead income you are expecting and the cost that you are going to incur. So this one involves rigorous forecasting and planning before you can be able to prepare a budget that is workable. So, but the idea is that the budget becomes a blueprint. It becomes a working document with which the management accountant can regulate the organization. Then we will set up some cost control measures. Control measures here is that you set standards. So if the cost is above that standard, it reminds you that yes, with the standard you set, the cost is now overshooting that standard, so that you have to adjust. So that is for cost management. And this cost management helps us to reduce overspending. It encourages careful planning, and it brings financial health to the organization. The financial health we are talking about is that it makes the organization to remain liquid. It makes the organization to be able to meet up with its day-to-day obligations, so that there is no time the organization will not remain in operation. And also, the financial health also help to make sure that that organization is on the way to profitability. And cost management helps us to mitigate risk, and also it improves our uh, our our standards. But in carrying out cost management, you are bound to face with certain challenges. One, people will resist change as you are bringing in new cost standard. Be expecting that some people will resist change, and also there's need for effective communication if you want to engage in effective cost management. And also, you must not underestimate, because at times, because you want to do cost management, you underestimate your expenditures. So at the end of the day, you run into crisis if you underestimate your expenditure. So now, what are the major tools we use in this cost management? One, budgeting. You must have a budget if you want to do cost management. And also, you have to track your revenue. You have to track your revenue, and you have to track your expenditure. Make sure that every financial transaction that is done in that organization, whether money is coming in, money is going out, everything must be recorded. And there must be reports. The report could be on a weekly basis, it could be on a monthly basis, it could be on a quarterly basis. But the thing is that, like most organizations, they on a weekly basis they track their expenditures, they track their income, so that they know the financial state of the organization. So there must be reports prepared to show cost incurred, expenditure incurred, and revenue generated. And also, it must be analytic. Analytic here means you are not just looking at the figures on their face value. You must relate those figures, changes in those figures with maybe what happened previously, and you can use it to predict what will happen in future. And also, you must also understand the interrelationship between those figures. Just like you can look at your sales and your purchases. Does it mean that when purchases goes up, your sales goes up? Does it mean when you do promotion, does it affect your sales? And also, you have to look at what are those expenses that affect your net profit. So that is, you go beyond the face value of those figures and go into a deep analysis. So it helps us in cost management. Now, in costing methods, what are the costing methods that we normally use? The costing method we use in management accounting, one is the standard costing. Number two is the job costing. Number three is the process costing. Number four is direct costing. Then we have target costing. Then we have activity-based costing. We shall be taking this costing method one after the other. One, the first one is we say is the standard costing. Standard costing refers to the process of predetermining costs based on the present standard. This is done under a specific operating condition. Standard costing use predetermined costs for material and labor. So what we are saying about standard costing is that because of past operation, because of history of your operation, and also because of what you are expecting in future, you can come up with standard. Maybe you say that every day, the total amount we are spending on light and energy it should be so and so. So it must not exceed that amount. Maybe you say that generator will run for maybe 5 hours every day, and this is the total money that has been set aside for it. And you say, okay, this is the number of workers we will maintain at every time in so month every day. This is total number of workers we are going to maintain. It must not be above and it must not be below. So you set a standard for it. And you set a standard that even when vehicles are traveling, you say, okay, this is the quantity of fuel that will be given to a driver, maybe going to Ibadan. This is the quantity of fuel. The one going to maybe Abuja, this is the quantity of fuel is expected to spend. And also, you set standard as to maybe manager, this is the cost of the hotel that you sleep. They must not sleep in an hotel above the standard that you have set. That is what we mean by standard costing. So you set standard, costing standard for all the activities of the organization so that it helps you to know whether you are getting above the standard or not. If you spend above the standard, you analyze what is the variation. If you spend below, you analyze what is leading to the variation. Then job costing. Job costing is different from standard costing. Job costing is like when you have a job to do and maybe you are submitting like a quotation and you are uh, you cost how much it will take you to start a particular job and complete it. Maybe a company that is into sewing of clothes, that company, maybe a school can approach that company and say, produce a uniform for our students, produce uniform for 500 students. That company will go and quote, we go and determine how much it will cost them for the material, how much it will cost them to produce them, how much they will pay for labor, how much they will spend in the generator and other, and how much they will spend for different design, so that at the end of the day, they say, for this particular job that has been given to us by this school, this is how much it's going to cost us. That is what we mean by job costing. Maybe a supermarket like Tetrazini might be giving a contract, say, this company is doing an annual general meeting. We want you to take care of the catering services there. So that Tetrazini will do a job costing for that annual general meeting. If another company is doing another thing, it's a different job. So each job has its own cost that which has been estimated. And it is that cost that they use to negotiate to know how much they are going to tell the client to pay. So that is for job costing. Contract costing is the same as job costing. The only difference is that in contract costing, the contract costing is that you have to add, from the quotation, you have to add how much is the profit you are expecting. The standard in most cases is that maybe the contractor will put 15%. If supposing a job is going to cost the contractor 10 million to do, he can say, okay, 10 million is the cost of executing this contract. But we, our own, that we are doing this, so the cost of material, the cost of doing this job is 10 million. But our own profit in it will be 15%. 50% of 10 million is 1.5 million. So when they are now submitting the quotation will be 11.5 million. 10 million is what will be used to execute the job, while 15 percent, which is 1.5 million, is what the company will benefit from doing the contract. So that is the only difference between job costing and contract costing. Another difference between job costing and contract costing is that most job costing is being done at the factory. The job is executed at the factory. But in contract costing, you may need to have to go to the client place to do the contract, of which you have to carry equipment to where you are executing the contract. Then we also have batch costing, like this company that produce different batch of products. Then you have the process costing. Process costing is for companies that are in continuous production. Process costing for companies that are in continuous production, just like Unilever, Nigeria Breweries. They are not waiting for customers to demand for their product before they produce. Then we have activity-based costing. Activity-based costing is for companies that they have certain activities that they cost how much to carry out those activities. Maybe the security activities, this how much it costs. Administrative activities, this how much it costs. Production activities, this how much it costs. End of year party, this how much it costs. The canteen, this how much it costs. So they divide the whole organization based on different activities performed in that organization, and they allocate cost to it. That is what we call activity-based costing. The last one is target costing. Target costing is based on the cost you want to incur and the profit. So in that case, you work your cost and the profit out because it is based on a particular target that you want to achieve. Just like I was talking about break-even analysis. You have determined your fixed cost, you have determined your variable cost per unit. And also, even where you want to make profit, you have determined the profit you set for yourself. That one, and you work towards that particular target that you have set. That's what we mean by target costing. So that is how far we can go today. We will continue in the next lecture. Like I said earlier, this is a tip of the iceberg. It is an invitation for you to go and read more about management accounting. Thank you. My name remains Dr. Clement Ogbani, and remain blessed.